The Budget 2024 announced a significant change for the real estate sector by removing the indexation benefit on the sale of property, reducing the long-term capital gains (LTCG) tax rate from 20% to 12.5%, but applying it without the indexation benefit. Experts believe this will increase the overall tax burden for property sellers and dampen investor sentiment. However, they also see potential growth in affordable and mid-level housing segments due to government initiatives aimed at revitalizing MSMEs and infrastructure development. What is indexation benefit? Indexation is used to adjust the purchase price of an investment to reflect the effect of inflation on it. The government has clarified that the indexation benefit for properties bought after 2001 will be removed while retaining it for properties bought before 2001. Former president of CREDAI Jakshay Shah said the impact of the proposed changes would be neutral if the average property return is 12% over more than 4 years with inflation at 5%. However, if the return exceeds 12% with 5% inflation, there could be a tax saving under the new amendment compared to the current rate, Shah added. Nitin Bhavizi, CFO, Ajmera Realty and Infra India, explained in a conversation with Money Control that for the sale of a property acquired after 2001 and 2024 or thereafter, the capital gains tax will be 12.5% instead of 20% earlier. Meanwhile, the long-term capital gains tax on equities has been hiked to 12.5% from 10%. So, if one considers moving the capital out from long-term capital gains from shares and securities, they are moving out with a higher tax effect of 25%. However, with real estate, they are moving out with a 37.5% reduced tax effect, he said. Impact on demand supply. Developers heavily reliant on investors will be adversely affected. However, the elimination of the indexation benefit when applying LTCG means the overall tax outflow will be higher under this new regime. This move is likely to dampen investor sentiment, removing key incentives and directly impacting developers dependent on investors, said Sachin Bhandari, Executive Director and CEO, VTP Realty. Shishir Baijal, Chairman and Managing Director, Knight Frank India, believes that if the property's value has increased more than the inflation rate, the new 12.5% tax rate is expected to be more advantageous for real estate sellers compared to the previous 20% tax rate after adjusting for indexation. The removal of indexation benefits could potentially lower demand from investors since indexation adjusts the purchase price for inflation, thereby reducing capital gains tax on property sales. Sans this benefit, the tax liability increases, and this will reduce the attractiveness of real estate as an investment when viewed against other asset classes, said Prashant Thakur, Regional Director and Head, Research, Anurag Group. According to Jain, high-value properties will be most impacted, and we may see a reduction in demand for them. Primary home buyers might not be affected as much since their main motive for buying homes is to use them for residence, not for investment returns. However, overall market sentiment could influence even end-user decisions, he said. Impact on realty stocks. Despite the concerns regarding the removal of the indexation benefit, shares of realty companies staged a sharp rebound on July 24th, surging up to 8%. Shares of macrotech developers were up 3%, Soba up 3.4%. Prestige Estates up 6.7%, Ajmera Realty up 3.21%, and Oberoi Realty gained 3%.